Hello and welcome to the lecture for week 7. In this week, I'm going to talk about liabilities, specifically current liabilities. So after talking about current liabilities, one of them that I'll cover is payroll. That's something that I didn't include in your reading. I won't include homework or test on it, but I do want to walk through the liabilities associated with that because it affects nearly every business. I'll then talk about contingent liabilities, what they are, how to record them, when to recognize them, and then I'll talk about short-term notes payable, primarily how to get interest in the right period, and then finally some bonus content. I'll talk about installment loans, so how to create an amortization table and how to record entries related to installment loans. You're familiar with those kinds of loans if you have a car loan or a home mortgage or those types of things. There's a variety of in-class practice throughout this lecture, and I'll tell you to pause and do a particular in-class practice problem as we go. So first, let's start with some important definitions so we're kind of all on the same page. So a creditor is the entity that is making the loan or extending credit to an individual or a company. So that would be a bank, a credit card company, a supplier that's extending credit to a customer, all of those kinds of things. Those entities are all considered to be creditors in that transaction. The other side of the table is debtors. Those are the people that are incurring the debt, that have the obligation, that have to pay it later. They're the borrower. A current liability, this is important. A current liability are debts that are going to come due within the upcoming 12-month window. So it's a moving 12-month window that we intend to pay with current assets. So the one situation where you might have a debt that is coming due within the upcoming 12 months that you would not classify as a current liability is if you have the intent and the ability to replace that debt with new debt. In effect, roll the debt over. In those cases, you could classify it as what you see next there, a long-term liability, which are debts that are due beyond that upcoming 12-month window. The most common type of current liability is accounts payable. Accounts payable are the obligations or debts that arise through the normal course of doing business. I order supplies from you and I give you a purchase order for those. You give me the supplies and you give me an invoice with terms that show that it's due in 30 days. That's accounts payable. That applies to my phone bill, my utility bill, anything that I buy from suppliers, any services that I receive from suppliers, the company that does the janitorial work, all of those kinds of things create accounts payable. It's a relatively informal kind of debt in the sense that we're not signing a formal contract. I give you a purchase order, you do something for me, you give me an invoice. So I would contrast that. Let me skip over the first bullet there. I'd contrast that with a note payable. So a note payable is similar, but it's a little bit more formal. So there is a contract, a promissory note that I have somebody sign. The benefit to that is it is easier to get a judgment against somebody, to collect from them through the court system if you have a signed promissory note as opposed to the less formal purchase order invoice kind of arrangement. So in doing business with somebody for either a substantial amount of money or somebody that you can't establish credit for them easily, a promissory note is a more secure way to extend credit to those people. So the current portion long-term debt, if you have a long-term debt, the most common type would be, say, a mortgage, a 30-year mortgage on a building. The current portion of that is the principal portions of the payment that are due in the upcoming 12-month window. So we'll take a long-term debt, and for presentation purposes, we'll split that into the current portion of it and the long-term portion of it. So one topic to cover that relates to accounts payable are cash discounts. So cash discounts are usually offered by vendors as a way to kind of speed up cash flow, to give people an incentive to pay their bills early, because that gives our business the opportunity to get the cash, buy more inventory, increase sales, that sort of thing. So payment terms are expressed as the most common one is 210 net 30. What that means, the 2 refers to the discount. So we can take a 2% discount. The next number is the number of days within which we need to issue our payment and mail it, so 10 days. So I can take a 2% discount if I pay within 10 days. If I don't do that, then I need to pay the net amount or the full amount in 30 days. That's when it comes due from the date of invoice. Terms could vary. They could be 115 net 30. I worked for a company once that had terms of 530 net 60. So if somebody paid within 30 days, they could take a 5% discount. So the terms can vary. 210 net 30 is usually the most common. One way to look at that is if I don't take that prompt payment discount, then I am foregoing a 2% reward in effect in return for being able to use that money for an extra 20 days. That converts to a 37% annual interest rate. So it really behooves companies to pay within credit terms. A lot of companies don't pay within prompt payment terms, not because they don't have the cash flow to do it, because they don't have the procedures in place, the policies in place to do all of the things that need to be done to get an invoice approved for payment and get it paid within that 10-day window. And it's low-hanging fruit. It's money laying on the ground that you just have to pick up. So whatever you can do to make sure that your organization is taking advantage of those prompt payment discounts really reaps significant rewards. There's also the side benefit that suppliers like doing business with customers that pay them quickly. So you tend to be kind of in the front of the line when it comes time to ask for favors or those sorts of things. So there are 2 different ways to record those cash discounts, and I'll talk about the most common, which is the gross method. So in this scenario here, we purchased $12,000 worth of inventory with terms 210 net 30. Invoice date of August 1st. So when I receive the inventory and the invoice, I debit inventory to increase that asset, and I credit accounts payable to increase that liability for the full $12,000. Then when I make my payment on August 10th, I am going to debit accounts payable to wipe that $12,000 off the books. I'm going to recognize that discount by crediting inventory for 2%, or in this case, $240. That reduces the cost of the stuff that I have on the shelf that I'm going to sell to customers. So that will increase my profitability when that stuff becomes cost of goods sold when I sell it. And then I credit cash for the net amount I'm paying, in this case $11,760, because I can take that $240 discount. So please stop or pause the video at this point and do in-class practice number 1 for week 7 regarding entries for prompt payment discounts or cash discounts. The next topic I'd like to talk about is payroll, and I want to, again, in a similar manner, start with some definitions. So payroll is the amount that we pay to employees for their services. It usually comes in 2 forms. Either salary, which is a flat monthly amount that's paid usually to managerial or administrative employees, that regardless of how many hours they work. They could work 60 hours a week, they still get that flat amount of money. Contrast that with wages, which are hourly payments to workers that they get paid for the work that they do, for the number of hours that they're working at the company. The key difference here is wages, hourly pay, is subject to overtime. If they work more than 40 hours in a week, and that is hours worked, not hours paid. If they work more than 40 hours in a week, the hours in excess of 40 are paid at a premium rate of 1.5 times their regular rate of pay. And that's a federal law. So that's important to keep in mind. There are 4 criteria. In Washington State, we use the term exempt and non-exempt. So salary employees are considered exempt, meaning they're exempt from being paid overtime, whereas hourly workers are non-exempt. They do get paid overtime. In Washington State, there are 4 criteria. One is that you supervise 2 or more people. The other is that you are a professional, meaning you have some sort of advanced education or license to do your job. And third is that you're engaged in some kind of creative endeavor. You can meet any one of those three and you could be considered exempt. If you don't meet any of those three, then you're going to be non-exempt and you will get overtime. Washington State has a fourth criteria, which is, are you paid less than $67,725 per year, $67,725 in annual pay. If your pay is less than that amount, then you are going to get overtime. You're going to be considered non-exempt. Even if you have met one of the first three criteria, you're still going to get overtime. So an employee's total earnings is considered gross pay. So if you make $20 an hour and you work 40 hours, that's $800 of gross pay. But as all of you know, that's not the number that's going to be on your paycheck because there are deductions which result in net pay, the actual amount on our paycheck. One of those deductions is federal income taxes that are withheld from your check and remitted to the federal government. An employee will fill out a W-4 form which says this is my marital status and this is a number of allowances. And then the person preparing the payroll will look that number, will consult an IRS table to determine how much to withhold from their check based on their gross pay for that period. That amount withheld is then sent to the IRS. So in this effect, the company is really a pass-through agent. Another deduction that affects all employees is FICA, which is Federal Insurance Contribution Act. That is what funds Social Security and Medicare. So this is up-to-date information here. Social Security is 6.2% of gross pay, up to $168,600 per year. Once you make beyond that amount, you're no longer subject to Social Security. Medicare is 1.45% of gross pay, and there is no limit on that. No matter what you make, you still pay that amount. There could also be other deductions. So some employers will ask employees to contribute towards their medical insurance premiums. Some companies have charitable contributions that can be done with a payroll deduction. Some companies have union dues that are deducted that way. There could be retirement saving plans that are done through payroll deductions. So there could be a whole variety of different payroll deductions. But again, in all of those cases, the company is the pass-through agent. They take it out of the employee's check and apply it to something else. So this graphic shows kind of the two sides of payroll. So I just talked about the deductions from the employee portion of the payroll, the federal income tax withholding, Social Security, and Medicare. The employer on the right side here also has some amounts that they have to pay. So they have to match whatever is taken out of an employee's check for Social Security. So if you make $10,000 in a month and they subtract $620 from your paycheck, the business is going to have to match that $620. The same with Medicare. They'll match what is taken out of your paycheck for Medicare. And so double the amount that is withheld from your check is sent to the IRS with your name on it. In addition to that, they have unemployment taxes to pay, federal unemployment tax and state unemployment tax. That is limited to the first $7,000 in earnings year to date for any employee. So once they hit that level, the business no longer has to keep paying unemployment taxes for that particular employee. So there are four entries that relate to payroll. One is recording the gross payroll, so debiting wage expense and crediting liabilities for each of the deductions. And then the net amount is wages payable, what will be due on payday. The second entry is recording the employer payroll taxes, so we'll debit payroll tax expense and credit the different amounts that are due to different agencies, so Social Security tax payable, Medicare tax payable, etc. Third, we'll pay the net payroll liability, so we'll debit wages payable and credit cash on payday when we issue checks or do direct deposits. And then fourth, we'll pay the payroll tax liability. We'll pay the government both the money that we took out of employees' paychecks and the money that we're matching. So I'd suggest you pause the video and do entry number 2 from in-class practice now. Please note that the publisher of this problem used some simpler percentages. So rather than 6.2%, they use 6% for Social Security. That's just to make the math a little easier. So please do that and then return to the video. Okay, next I want to talk about contingent liabilities. So contingent liabilities are liabilities that arise from something that is happening now, but it's going to trigger a payment in the future. And we want to recognize the expense and the liability now so that we can match it to the revenues that we are earning now, because it relates to those revenues. A really good example are warranties. So if I sell a product today and it has a 10-year warranty, I know that there is some likelihood that when I sell that product today that there will be a warranty claim down the road, and that's going to cost me money. So the matching principle says that I should match the expense of that warranty with the revenues in the period in which I use them, or I'll distort the picture that I'm communicating to readers of the financial statements. It could be lawsuits. I could get sued this year and it may result in me having to pay money 2 years from now, as an example. I could violate some law and have to pay a penalty, and the penalty will be paid a couple of years from now when it's all sorted out. I want to recognize those things now. So the criteria that we use to determine what should we recognize and what should we not recognize is based on 2 factors. One, what is the likelihood that I'm going to have to pay money in the future? Is it probable? Is it reasonably possible? Just kind of maybe I will, maybe I won't. Or is it remote? It's unlikely that I'm going to have to pay anything. That's the first criteria. The second criteria is measurement. Can I estimate what the amount's going to be, or is it simply impossible to estimate that? So this graphic kind of shows you what the decision tree is for that. So some contingent action has happened. Let's say, as an example, the company is sued for something. So I'll first look at what is the likelihood, and I may consult an expert or an attorney or somebody that can give me some objective feedback about what the likelihood is rather than me guessing myself. So if it is probable, if it is very likely that I'm going to have to pay something, the next step then is to say, can I measure it or not? If it's probable that I'm going to have to pay something and I can estimate it, then I'm going to record an expense and I'm going to record a liability. So I'm going to create a journal entry in my financial accounting system that shows that I've got lawsuit expense and claim settlement payable. Okay. If it's probable but I can't estimate it, it's just there's not enough information, I can't really come up with a reasonable figure, then I'm going to disclose the liability in my financial statements. In the footnotes, I'm going to say, this happened, we were sued, it's likely we're going to have to pay something, but we can't guess what it might be at this point. So I've let somebody know that that exists. If it's just reasonably possible, then I'm going to disclose it in the same way. If it's remote, I don't have to do anything. I don't have to disclose it, and I certainly don't have to make an entry. So if you could stop and look at in-class practice number 3 and complete that, and then come back to the video. If it does follow that top line, so if it is probable that I'm going to have to pay something and I can estimate what it's going to be, I'm going to make an entry like you see on the top there. I'm going to debit warranty expense in this example, and the textbook uses the account allowance for warranty expense. I prefer to use the term warranty liability or warranty payable to make it clear that it's a liability. And the key thing here is later when I actually pay the money or honor the warranty, I'm not going to recognize an expense at that point. I'm going to reduce my liability. So in this case, I provide some products to a customer out of inventory. So I debit the liability, which again they call allowance for warranty expense, and I credit the inventory to show I've taken parts off the shelf and given them to somebody. So if you could pause at this point and do entry or problem number 4 in your in-class practice, that would be great. Okay, a couple of quick topics that I want to cover. One is sales tax liability. So when a retailer sells something to an end user, They're, of course, collecting more cash from that end user than what the sale price of the item is. So the sale price of the item is what we're going to use, the number we'll use to credit sales. I'm going to add sales tax, so that customer is going to pay me for the sale price of the item plus the sales tax. That creates a sales tax payable. It creates a liability. The business is the conduit from the customer to the state that we are doing business in that receives the sales tax. Later, when we pay the sales tax, we debit the liability and we credit cash. So pretty simple. We covered this earlier in our course, but I just want to return to it because it is, again, a type of current liability, and that is unearned revenues. Sometimes you'll see the term deferred revenues, which, when you see the word deferred, think of delayed. So this is where a customer pays me up front for something and I haven't earned it yet. I owe them the money back if I don't do what we agreed that we would do. So in this case, I'm renting somebody some space for $120 a month, and they pay me for 3 months in advance. So I debit cash because I'm receiving the cash, and I credit unearned rent, which is a liability. If I decide I don't want to rent them the space after all, or they decide they don't want it after all, I owe them that $360 back. That is going to be reduced. We're going to whittle that down as the months go by and they occupy the space. So each month that goes by, I will debit that liability to reduce it, and I will get credit for the revenue. I'll recognize the revenue as I earn it by crediting the revenue. So that's, again, a bit of review from what we did in the past. The next topic I want to cover is interest payable. We're talking here about a short-term note, so a note that is due in less than a year, and it's a simple type of note. So the issuer or the lender, the creditor, is going to tell us you can borrow this much money, and you will pay the interest in total when the note matures together with the principal. The key thing here is if the term of that note goes across our year end, we're going to want to make an entry in the first year to recognize at December 31st, time has gone by, we've owed money, interest has accrued, we want to recognize interest expense and credit interest payable, like you see in this entry here. We'll do that on December 31st. And again, the way to calculate the interest is the face amount of the note, how much did we borrow, times the interest rate expressed as a decimal, so 6% would be 0.06, times the number of months that have elapsed divided by 12. So if I borrow money on October 1st, the entry will be the face amount of the note times the interest rate times 3/12 for October, November, December. Then when the note matures in the following year, I'll again accrue interest from January 1st through the term of the note, and I'll accrue interest for those months, and then I will pay the note. And when I pay the note, I'm going to debit note payable, I'm going to debit the interest that I've accrued, so I'll debit interest payable, and then I'll credit cash for the full amount I'm paying. So if you could stop and do in-class practice number 5, and again compare to the solution, that would be great. So the last topic I want to cover are installment notes. Those are notes where they're issued usually for the purchase of an asset, and the asset is pledged as collateral for the loan. So a car loan, a home mortgage, those kinds of things. Could be a loan for a piece of machinery in a business or a computer system or something like that. The key thing is that the payments are a constant amount. They don't go up and down. You pay the same amount every month, and the payment is going to contain a portion of it is related to interest expense, and a portion is going to reduce the principal, pay down your loan. The interest is calculated based on the carrying amount of the loan. So when we borrow the money, in this case we borrow $24,000 from a bank for 5 years at 6%, the bank is going to use a formula to determine that those terms would result in this case they're making annual payments, not monthly payments. It would relate in an annual payment of $5,698. So the initial entry when we borrow the money is we debit cash and credit note payable. We've done that before. And then in order to know what the future entries are going to be, I need to do an amortization table. So that amortization table works as follows. On January 1st, I borrow $24,000. That amount is due for the entire year. So I am going to make a payment at year end of $56.98 on December 31st. The interest on $24,000 at 6% for a year is $1,440. So of that $56.98 payment, $1,440 is related to interest. So the remainder, in this case, $4,258 or $56.98 minus $1,440 is what's going to pay down our loan. So once I've made that payment and the $4,258 is applied to what I owe, I will then owe $19,742. That becomes the carrying amount on January 1st of the next year. Okay, so then I do the same math. 19,742 is due all year. What is 6% of that? It's 1185. So of 5698, 1185 is interest. So the remainder, 4513, reduces my loan, which brings it down to 15,229. I keep doing that math each year, and in the last year, that lower right corner will zero it out. So the principal portion for my last payment will equal what I owe on the loan. The reason I need to do this is as I make each of those $56.98 payments, I know that I'm going to credit cash for $56.98 because cash is leaving my business, but I need to know what to debit. So in this case here, in the first year, I will debit interest expense for $1,440 and debit note payable for $4,258. And of course credit cash for $56.98. The next year my debits will be different based on the amortization table. So hopefully that makes sense. I would suggest at this point that you do the in-class practice problem number 6, which requires both doing an amortization table by hand and doing the entry for the issuance of the note and the first payment. And then please check your answers with the solution there. So hopefully that makes sense. If you have any questions, as always, please reach out to me, and I look forward to talking with you in the lecture for the next chapter. Thank you.